many people who would have said, no, you are doing business with poor people, but poor people should be supported, and it's not a business part. People on the ground, they want to be a part. It's all about creating the opportunity for these people. Today we manage $5 billion US. We have invested over the 20 years more than 15 billion. It all goes into emerging markets. All goes into markets where still, of course, where you would say, yes, here the problems when it comes to poverty or when it comes to access to education, to healthcare are large.
So what success looks like to us, it's carbon emission reductions, and it's also to the extent that we can quantify them and articulate them, the other environmental and social benefits associated with what we're doing. I firmly believe that we've got a big problem to solve in this world, not just to create more clean energy infrastructure, but to stop wasting this ridiculous scale of waste in the system. What if we needed and wanted to do something about this? What if we needed to cut carbon? What if we needed to improve resource efficiency because we're just using much more than the planet can produce sustainably? We're just using too much. What exactly can we do about this?
You started in consulting, and it was likely this consulting company of this professor that you were doing.
It's a very interesting story because the professor had this contact to a company which is, it's still there in existence today. It's called today International Project Consulting or something like that. And this company was specialized. I'm talking in the 80s. I'm talking really the 80s. This company were really specialized in what we call financial sector development. And then at that time, I'm talking the early days of what later has been known microfinance. Microfinance was basically a subsidized activity, subsidized by public sector players. So the German government, the Swiss government, the Inter-American Development, the World Bank. But at that point in time, the real discussion was, okay, now, can it be also a profitable activity or should it be a profitable activity? So all these questions, and these questions were very fundamental discussions on, for example, is it okay to do business with poor people? That was so to say, a really conceptual question at that point in time. They said, okay, we are doing this now since 10 years, they were doing this. They were typically, their instrument, which they used was, if I was running at that point in time, these were non-government organizations, NGOs, and they were extending loans to micro-entrepreneurs. The typical package was you got $500,000 at 40 years loan at 40 years in local currency at 1% interest rate. So it was a subsidy because, basically for 40 years at 1%. So basically there was no payback at the end. And you got $100,000 technical assistance back, support for the institution. And they have been doing this all over Latin America for many years. And then they said, now we want to do a study. We want to do an evaluation of the program. And the consultancy company in Germany got actually that contract. And then they were looking for people who were interested to travel around Latin America for 6 months and to evaluate the whole program. I mean, the whole thing. And we did analysis of 40 institutions in 6 months, a team. And the person running the consultancy company asked me, my professor told me that this is an opportunity and they're looking for people. I hardly could speak Spanish. I did some Spanish learning myself at home, but I was not familiar, and it was all in Latin America. And so I met the people from the consultancy company. I said, look, guys, I'm interested. My Spanish is very poor, but I'm interested. They said, no, don't worry. You will learn Spanish very quickly in a couple of weeks when you are on site. And so I accepted the job for 6 months and basically ended up working for the consultancy company around, I can't remember, 5 years. And the interesting thing was, if I may say so, because this study never has been published, because when we finished the study, and it was a team, it was not me alone, a team was working on this. I thought we were a number of people. The results were devastating. The results were, we analyzed 40 companies, and out of the 40 companies, there was only one single company who was, after a number of years, capable to cover costs. Everybody was losing money. These days, today, we are talking about sustainability. So at that point, we of course already were talking about sustainability, but one aspect of sustainability was, and still is, of course, financial sustainability. I mean, if you have something which is not financially sustainable, it
doesn't matter what you're doing.
And the frustrating thing at that point in time was, yes, they were running this program, but unfortunately, it was not designed to bring these companies to a financial sustainable level. And that was a very important, it was a tough message. And from there, the whole discussion on how to deliver financial sector services in a more commercial approach with poor people or with micro enterprises or micro entrepreneurs, though these people are the poorest in these countries or belong to the group of the really poor people in these countries, but to build a sustainable relationship so that these people don't have just access once to financial services, they can access on a sustainable level. That was a challenge at that point in time. And so I came into the topic, and so I stayed working as a consultant for a number of years with a lot of projects around Latin America, but also in Asia, because the consultancy company at that point in time did two things. One is trying to work with financial intermediaries at that time, basically in Latin America, so that they could offer more adapted, better financial services to these people, to micro entrepreneurs, but they do it on a sustainable level, also financially sustainable. That was one category of work where I have been quite a bit of involved there in a variety of countries. And the other work is regulatory work. And regulatory work, I mean, because when you, at that point in time, and now it's slightly different today, but when you at that point in time, you wanted to establish a financial sector institution, let's say in Peru, in Bolivia, in Colombia, in these countries, the regulation was not made to allow smaller players to enter into the regulated financial sector. But being a regulated entity when you do financial services is super important, because when you are non-regulated, of course, you never can take deposits. So you only can do credit, which is for payments, which is a different thing. But when you really want to develop a fully fledged, broad financial services, it's super important. You can get into the formal financial sector, but that needed changes to the financial sector laws in the countries. And so the company was specialized in assisting central banks, supervisory agencies in developing adequate financial sector development legal frameworks. And that was the part where I got deeply involved into what it structurally means, what are the key elements, so that what we call in today's terminology already, the enabling environment. How can you create an environment that entrepreneurs, people who want to build something, can actually build it? And this is the basis then for later having also investment opportunities, because when these companies do not evolve, there's also no investment opportunity.
Was this to establish the regulatory framework in these countries to set up microfinance institutions, which didn't exist before, in a way that they could take investment in?
I give you an example, and the example which is probably a very well or better known, though at that point in time, I'm talking Latin America. Bangladesh, Indonesia have slightly different stories, but actually the front runner when it comes to formal financial sector inclusion, formal financial sector institution, Latin America was the front runner there. All the institutions we were analyzing when we did our job, the consultancy, they were all NGOs. They were unregulated financial sector players, in the term semi-formal. There was a company, it was an NGO, an association, a foundation, and the foundation was doing the job, but they were not supervised by the regulators because they were not in the formal sector. Now, when you have such a company and you want to be part of the formal financial sector, you have to play to the rules. But you can imagine, I give you just a simple example also for everybody, listening to this to really understand what we are talking about. At that point in time, you want to establish a bank in, let's say, in Bolivia or in Peru, but it could well be that the minimum capital you needed was, and I'm inventing, I can't remember, $25 million, let's say. You need $25 million to establish a bank, because otherwise the regulator would say, no, it's not serious, it's too small, and you cannot. So basically, one of the key elements was kind of, okay, here is an institution which probably can come up with $4 or $5 million US, and they can enter the financial sector as a small entity. But this needed a change in the laws, because the laws didn't allow for this type of, let's say, development from below. That's what we wanted to achieve. And so we had then to work with the regulators to say, look, you can do this, but then this triggered quite a bit of changes in other regulations so that the regulator felt comfortable that they can also regulate this entity, because they had also to supervise these entities. And the regulators are, of course, with good reasons, they are very hesitant of doing these type of things, because they say, if things go wrong, we have a big problem in the country, because this is financial sector, and financial sector builds on trust and confidence. We have to make sure that things are very well done. And so we try to assist the regulator, in these countries to say, look, there is a way of doing it, but you have then to change quite a number of laws, decrees, whatever it was in these countries, to allow these players to step by step convert from a non-regulated into a regulated entity. And the first one in Latin America, which did this step, was actually an institution which still exists today. It's Banco Sol in Bolivia. At that point in time, it was an institution in Bolivia. They got the approvals from the government. Actually, it was a project I have been working on together with others to develop this. And then this was the first one which developed. Parallel to this, some neighboring countries had, slightly different approach. Also, this consultancy company was also assisting very strongly Peru. It's not so well known these days when people talk about microfinance, they would talk about many people who are not so close to these developments. They would know Bangladesh Grameen Bank. Actually, bank for a long time, it was not a bank. It has a name bank. It was not a bank, but now it is. But at that time, it was not. Or they have examples in Indonesia, which were early on there. But in Latin America, it's typically Bolivia, which stands out. And it is Peru, because the Peruvian regulation allowed for establishing, again, with the assistance from Germany, they copied what in Germany is known as a Sparkassen system. So these are institutions which belong to cities. And so they copied the system. And therefore we have in Peru today, it's actually worldwide, I still would say it's one of the largest microfinance initiatives which ever happened globally. And it's called the system of cajas municipales, which means these are the savings institutions belonging to the cities in Peru.
So this was in the 90s or in the 80s?
When did it all happen? Look, I started for the consultancy early 90s, and this happened in the first 5 years of the 90s. So I think the laws and decrees in Bolivia have been passed 93, 94, around this time. And that was a moment where something interesting actually, happened. There was 10 years earlier, many people who would have said, no, you are doing business with poor people, but poor people should be supported. And it's not a business partner. People on the ground, and we can come to this. I think it's a very interesting topic. They look at it, they want to be a partner. It's all about creating the opportunity for these people. And so, of course, when people with let's say from developed countries might, and still today, they look into this and say, how on earth are you doing business? Are you even charging high interest rate to these people? They are paying much higher interest rate than in a developed country. We can explain why this is the case. This should not be the case. But what happened end of the 80s, beginning of the 90s is that this mindset started to develop where people understood, of course, it is not good to have very high interest rate. Everybody agrees. This is clear. But it's also not good when the provision of these financial services has to be subsidized, because when it's subsidized, it is just not sustainable. So we have to find a way in the middle where we can offer the services. We create opportunities for people on the ground, and actually we work on providing these services more efficient so that the interest rate also comes down.
In the early 2000s, 3 Swiss guys, Leo Bachler and Armin Williger and Klaus Tischhauser, they decided to form responsAbility with a focus on financial inclusion, not in Latin America, but in Africa. And you, Rochus, became part of their original team. And everyone only thinks that Switzerland only has developed chocolate, cheese, and watches.
We are also quite known for microfinance or funds and players. But yeah, you are right. Chocolate is much more famous, and watches.
What's the timeline or series of events that leads you from consulting with governments to joining this startup? What was your interest at that point? And I know we're still covering early chapters in your career, but I really like looking at these things closely because it shows the development that you went through, and also because these were very early days of impact, and this was far from a sure thing. And I think that makes, at least for me, a fascinating study because people get to see how you got to the point where you could build success on top of success in the field. And it wasn't just a straight line out of your boarding school to university to responsAbilities. So how did you get to responsAbility, and what were you doing there with them?
The situation was the following, because I was, as I said, beginning 90s to the mid 90s, roughly. I was working for the consultancy company. I found it's also so interesting. I don't complain about it, but we really worked hard, and basically we just continued working because it was so interesting. And I learned a lot of things. It was actually in each, at that time when we say in each mission where we went to a country, I don't know, I visited 35 countries where I worked. It was very interesting, and a lot of learnings. I'm still very thankful for this experience because you are on the ground, you see what works, what doesn't work, and you are asked to analyze the situation, conclude, and say, how can we improve? That was my job. How can we do better? And so I learned a lot of this. But then I, basically for a number of years, I worked only on regulatory frameworks, not for the consultancy company, with 2 Bolivian friends of mine, which I knew through my project. And we really specialized only on regulatory frameworks was a topic where, but at that point in time, I mixed it because I got offered a job in Switzerland. Say, hey, somebody asked me, but Rochus, I was working as a consultant, but the consultancy was not always like it was 3 weeks here, 2 weeks there, not continuous. And I was saying, hey, we are also looking for somebody who can teach students in mathematics, and I said, great, I can also, I like this because I like mathematics, And so it was a mix of things which I was doing. And then what happened was I was also working from time to time for the Swiss government or for some Swiss players in that field. And they do these conferences, and they invited me and said, Rochus, we do a conference. Could you give a talk? It was back in 2000, I think 1999, 2000 or 2001. And they said, can you give a talk about private sector investments into financial sector in emerging markets? So basically investments into microfinance. And I said, of course I can do that because I was building microfinance institutions as a consultant. So not only the regulatory frameworks, also we were working with institutions, building them up, and there were investments. I said, I can share what I know. And I gave that talk. And these people also invited Klaus Tischhauser and actually a second person who also co-founded the company responsAbility, Ivo Knöpfel. So they both came to the talk. I gave a presentation. And then they approached me and said, Rochus, look, we both are from the financial sector. They came from fund management, asset allocation, also doing already, Ivo is one of the pioneers of ESG investments. They had this concept in mind, but they say, what we are missing is we have no experience of doing investments in emerging markets with a specific, let's say, impact topic like microfinance. We have no experience. We need somebody who has some experience. And I was doing it already for 10 years. And so they said, look, we are setting up the company. We have very little resources available. I said, look, okay, we found an agreement. I said, look, we basically do this for a very small fee, because I said, I can do some other consultancies where I cover my cost, my living. I understood there was no fund, there was nothing. And so I started basically then working. The company was founded. There were no fund, no assets. We started from scratch. They were knowledgeable about how to set up a fund. What does it mean regulatory wise? And so they did this part and said, but on the investment side, they said they were all building on me and said, Rose, tell us, what should we do? And then, they had contacted some partner institutions, some other players in the field who could bring some deals. But they said, we have no clue how to analyze a deal. Is it a good deal, a bad deal? What should we do? And my job was basically, if you want, so I was at that point in time, so the first investment officer of the company, because all the deals came to my desk and they asked me the question. So how do we assess this? And we did at the very beginning of the company when we started, and I can share a bit, it was in 2003 now, when the first fund was approved and we could do the first deals. Basically, we did for the first year, I would say at least, we did all deals assessments together so that they could learn. I trained everybody, it was only 4 or 5 people we were on the job. And okay, look, what is relevant when you look at this? And there we started like this.
And then in 2016, you actually became the chief executive officer. So tell me how that came about.
We were running the company and I joined my first position in the company when I formally, so to say, not as a consultant or trying to help out, really formally. There's a different story to this. We also, we started on the private debt side. So most of our funds do private debt investments. So we provide loans, let's say, to companies in emerging markets. But we also very early on saw the opportunity to do private equity investments. And as I have been doing some equity investments, so I started to be the head private equity of the company with a very small team. And so I have been building for a couple of years private equity practice of responsAbility. I joined around 2010. We formed, there was some change on the executive management. Klaus was there as CEO. And then we had another person, Christian, who was working on the private debt side. And basically we built an executive management team of 3 people, the CEO and somebody as a chief investment officer for debt, and myself, the chief investment officer for equity or private equity. And when Klaus took the decision around 2015, I said, okay, he was doing this since 10 years, that he wanted to move on because he had always planned to go sailing, like he got into that. That was his idea. And he was very transparent. He always told the shareholders and the board members, look, the moment will come. Then the board of directors looked into this. Now, who should be the next CEO for the company? And then they selected myself and I accepted this. And so, okay, I was not, again, people would say, but Rochus, be honest. And so I was not working in the company and one day I will be the CEO. And so it came up and I said, okay, that's a good opportunity. And so I took over as CEO and now I'm working in the position as CEO now already since 8-9 years.
Maybe this is a good time to put a pin in this just for a moment before we start to really drill down on responsAbility. And you can tell me what impact investing means to you personally, because many people are using this word. And I'm sure all of these experiences that we've been talking about gives you a unique perspective when you're working exclusively in the emerging markets, and it drives what you're doing with your life.
My very first consultancy, I don't know, it's 1991, at that time. My first job was, first country I had to go to Costa Rica. That was part of the 40 institution we had to cover, and it was Costa Rica. And I remember it was the first time I was out of Europe. My Spanish was very bad. I arrived there. We started to work. We worked until Saturday. But there was a Sunday and I had off. And on that Sunday, first Sunday actually, I said, okay, if I have a bit of time, I went to a taxi driver and said, okay, please bring me to the poorest area. Actually, Costa Rica, outside of San Jose. Costa Rica is not the poorest country, but at that time, I'm talking back in 1991. I said, bring me please to the poorest part of San Jose. And he did that. He said, you should not go into this area because, there's a bit there. But I said, no, I want to go there. And I would like to ask people just to learn. And I went into this and I asked, it's Sunday, but these people work on Sundays, it's not, there's no Sunday, life continues. And I asked them, what does it mean for that? I mean, what is it actually? Just listening to the people on the ground. I personally have to say, I learned something, which was then, of course, I saw it many, many more times later. But at that point in time, it's all about the opportunity. I stick to this since today. I have to say, even in our vision statement here or in our purpose, it's creating that opportunity for somebody who doesn't have an opportunity makes all the difference. And I have this, you asked me on impact. For me, look, I know these days impact has developed and, there's SDG, there's all type of things out there. But when we come to, in simple words, let's say people who are really at the bottom, of the income pyramid, poorer people in these countries and the way they grow up, they are so limited very often opportunities. And it's not only finance, it is education, it's healthcare, it's many other things. There's no access to this. And I'm telling also still today, I'm telling people, investors here, don't forget, having an opportunity or not having makes all the difference for these people. What people do with the opportunity is a different thing. It's like in school, you teach 20 people and some people do great things and other people do less great, but having that opportunity, accessing and financing is as much as we can say financing is it, but financing for people who have so limited resources and say, now I get this $200, $300 at that time. Today it's 500 or 1,000, but let's say that is very powerful. Now, it is also bad things can happen. All that type of things can happen. It's not without problem, but I'm saying, who am I sitting here, growing up in Germany, even going to a boarding school, having good education, all of that. Who am I to say, but these people, it doesn't matter. No, it matters for them whether they have a new opportunity. And for me, when we talk about impact in emerging markets with regard to how can we include more people into the opportunities, it's all about this, which makes a big difference. And yes, we can then put many complicated metrics around this and do things. But ultimately, it's about creating these opportunities for me, for people. Of course, when we now talk about climate finance, there's other type of things which come into play. But in a nutshell, where I grew up with seeing the reality of these people on the ground and saying, okay, what can we contribute? And that's also in the name of the company, responsAbility. The A is about, there is ability on the ground. And we also, what can we do that people can use this access to opportunities? And I'm talking about financial sector. I can talk about access to energy, clean energy. I can talk about access to healthcare. I can talk, there are many of these things. That is where in emerging market, I think the core impact basically happens.
High-level overview of responsAbility, its mission and investing focus, and what asset classes are you investing in and so forth?
Very simple. The company has a clear vision. We envision a sustainable world with access to opportunities for all. That's what we envision as a company. And the mission, like the way we do this, and the wording is, we create products, investable opportunities for different type of investors, private sector investors, public sector investors, to basically make available for them investment opportunities, which all flow into emerging markets themes, the themes which I mentioned earlier. That's what we as a company do. And this hasn't changed over the 20 years now. Company was founded 2003. When I look today we manage $5 billion, to put it at $5 billion US dollar. We have invested over the 20 years, more than 15 billion. Yeah. And all goes into emerging markets, or all goes into markets Yeah, where still, of course, where you would say, yes, here the problems when it comes to poverty or when it comes to access to education, to healthcare, are large. All our investments are done in 3 themes, and we typically structure products along those themes. For example, climate finance mitigation can be a fund, or energy efficiency can be a fund offering, where a product offering where investors who invest into the fund know all the money goes into this direction and it supports, let's say, climate mitigation measures or adaptation. Or we do sustainable food, or we do financial inclusion. We do, from an asset management perspective, we basically only, with some little exception, only do private markets. So we are not invested in listed stocks or bonds. There's one product where we do this, but that's more the exception than the rule. Our strengths, and 98% of all the assets, private market. And in the private markets, we do private debt and private equity. We do both. Yeah. So if you want to, in a nutshell, the company is a specialized asset management house. In today's terminology, an impact asset manager with focus on emerging markets and with focus on creating access to opportunities for people.
So of this 5 billion in assets under management, which is enormous, how would you split between private debt and private equity? Because you make it sound like you're listed debt, and I think you also invest in fund of funds, but that's very small, I imagine. So today we should really focus on private debt, private equity. About what percentage do you have?
Private equity is roughly 35%, and private debt, 65%.
So these other two are very, very small. And then you made a point of saying not at all on listed equities. Tell me why not?
Our vision on admission is all of our investments, which we do, contribute to these developments on the ground in these markets. Now, most of these countries and the companies where we need the companies to invest are not listed companies. So if they would be listed companies, that's a completely different thing. But in these countries, what we call the capital markets are not yet so developed. What we call the investee companies, so our partners in the countries, because we don't invest directly in people, we invest in companies. The partners in these companies are, to the largest extent, are private companies not yet or not listed. Some of them will never be listed. That's one. So you have to go to this segment. You have to play in the private market in these countries if you want to broadly contribute. Yes, some of our investee companies, we invest equity, and over our investment period, they list on a stock exchange. In India, for example, this is the case. We have a couple of those cases. When this happens, that's a good thing. But when we want to build a portfolio, a broad portfolio, we could not build this portfolio only on listed stocks. That's one. The second argument is a different argument, is an argument which is important to make. When you invest in a listed stock, you have to be very clear. It's a secondary transaction. I mean, when you buy shares on the stock exchange, somebody sells. So that's the logic of it. It's not like you participate in an IPO. That's the exception. The normal thing is you buy shares, somebody sells. So from that perspective, your impact on the real economy is very different from when you do private market investments. Because when you do private market investment, there's a loan, for example, which goes into the company, and this loan helps the company to grow the balance sheet and to do more under their business model. And so when you look from an impact perspective, there is a big differentiation between impact through private market investments, equity debt, or impact in listed markets. To put it for people listening or interested in this, I would even go so far, look, there's nothing wrong. And of course, the majority of the investments happen in listed, in public markets, obviously. There's nothing wrong with this. It's just people have to be aware that, of course, you do that. The real world impact is very different from when you operate in private market.
What regions are you active in, and what countries do you have people on the ground?
Investment-wise, as we speak today, we are investing in around 70 countries, roughly. Where are these countries? Asia, Southeast Asia, Central Asia, Africa, Latin America, also Eastern European countries. So that's the large landscape of countries. Yeah. And yes, for doing this, we need people on the ground. We employ today roughly 270 people, roughly. Half of them are on the ground, or even more than half of them are on the ground, and the other half is in Switzerland. So we are headquartered in Switzerland. And when I say on the ground, what do I mean? Yes, I mean we have office in Lima, we have an office in Nairobi, we have office in Mumbai in India, we have people in Singapore, we have people in Tbilisi in Georgia. So we need in these locations people with local insight, local know-how, language also. Language is, of course, for us very important. What we mean when we say on the ground, to identify the investment opportunities, but also to carry out the investment opportunities. And so that's how we are structured. And each investment which we do we have a direct relationship with the investee company.
And how many funds do you have? Because I think you have a lot.
There's a lot. We have more than 15. I was saying, people say, oh, you should know exactly. But the point is, yes, look, it's a large landscape which we developed. Yeah, there is a number of funds which have the topic financial inclusion. There are a number of funds in climate, either energy efficiency, or there are funds where it gives access to energy. These are different nuances, different funds managed for this topic. Or, for example, a fund, and I just come out of a meeting with people talking about climate smart agriculture. So this is about climate adaptation investment. So it's a super important topic. It's not so easy to make it investable. And then, there's financial inclusion. There's sustainable food. Yeah, so we do investments in sustainable food, specifically, on the private debt, but also on the private equity side. And so we have developed that landscape. All of those funds are, if you want, so you could say these are thematic funds. Because what we do, because it makes things also for the investors easier to understand it's not an impact fund. These are all impact funds. But when you are an investor in these funds, I invest with the objective of access to energy in emerging markets. That's my theme. Or I invest with climate mitigation in mind in emerging markets. And there are many investors, institutional investors, but also private sector and, private people, like us, who are looking for these type of investment opportunities. And then to say, I want to have something in climate. And then it's easier to understand. It's not a mix of things where everything comes together. That's the other thing, of course, when you do in public market and listed market, basically you see an impact, BlackRock, impact fund. There's all type of companies, all type of companies there. And it's a very different approach. What we do is, as I said earlier, we identify a problem as an investment opportunity. We look, is it investable? Very important to mention. It's not impact first. So what we do is we ask ourselves, is the risk return profile good enough for the investor? Because this is very important. There needs to be financial sustainability, because if it's not there, it's either not interesting for the investors, or the company cannot provide the services over time. So it's very important to include this type of things. But as we look at only companies which have a very specific business model, you have basically the impact always built into this, because we select already the companies from the beginning under a certain criteria.
Are these funds open or closed-ended, or are they both?
They are both. There are open-ended funds and there are closed-ended funds, depending on the topic, depending on the asset class. So there are different approaches. We structure the products, to what are the needs for the underlying, for the investment opportunity, but also from the investors. Because Some investors, of course, can't even invest into structures which are closed end because regulatory wise, it's not possible. And some investors don't want to invest in this. They want to be in an open end structure. So we have to bring all of these things together to be successful.
And are any of these open to retail investors, or are they all for qualified investors?
Only for retail investors in Switzerland. And this is a very big topic. It's a very big topic on, so to say, the agenda when you see discussions on impact investment and how things could or should develop. Many people would say, but ideally, we also should have more offerings for retail investors because retail investors also, they have an interest to do these investments, but very often there is hardly any offering available of these type of impact. Yes, I can go to the KKR or BlackRock impact fund probably, and I do this, in public market. That's a slight different thing. And many people understand this and many people complain also, but this is driven by regulation. So because the underlying assets are not liquid, there is no daily liquidity in these offerings. And therefore, with good reasons, and I'm not misunderstand, there's good reason the regulators are very hesitant or restrictive on allowing this to be an investable opportunity for retail investors, because they are saying, but then, that there can be situations where retail investors want to have their money back and they don't get the money back because the underlying assets are illiquid.
I'd like to now try to drill into your investment process that you go through. Based on what you described to me, we'll just maybe limit the conversation to private equity and private debt, since that's really the main part of your business. And we'll get into specifically impact in a minute because you have a very unique and thorough process there. But could you walk me through at a high level what you're looking for when you're selecting an investment? So we're talking about more the financials perspective. I just want to confirm something for people who are listening who might not be familiar, but I think you're working through financial intermediaries. You're not doing direct investment.
Let me explain. No, it's very important because this sometimes for people can be confusing. Yeah. When people say we do investments, financial inclusion, this always, there's hardly there's no exception. It means you don't go to the final beneficiary. You finance a financial intermediate, a bank, to put it very, you finance a bank in Ghana, as an example, because you cannot go to the micro entrepreneurs and say, I give you a loan. That is nothing. It's also not conceptually the right thing. The right thing is you finance financial sector players in the country, and these players provide the services to SMEs, small and mid-sized companies, micro entrepreneurs, people who otherwise would probably not be included in the financial sector. That's one. When we are in the agriculture sector, but we finance, for example, a cooperative, a producer co-op, it's also a company. And they, of course, have many people who are part of the cooperative and the money flows there. But we go through a company, but it's a direct investment into agriculture value chain company, somewhere in the value chain. And the same as when we go into, let's say, climate finance, there are many companies we work with. They do renewable energy project development in emerging markets. So we finance this company in Thailand, in Vietnam, and this company in that country develops for other clients renewable energy projects. Many people would say what we do is direct investment. It's all direct investment, but of course, then these companies provide service and to the ultimate beneficiaries, because we cannot do this directly ourselves, and nobody would, conceptually, it wouldn't make sense.
I think it's important that when you're talking about making investments, you're writing fairly large tickets to these financial intermediaries who actually do the on-lending and make the $4,000 loan. I just want to make sure people aren't confused on that. That's what you're talking about when you're defining your investment universe. You're defining who you're going to lend to, who's then going to take your money and ultimately get it in the hands of the people or the companies that you're trying to help. So how do you define your investment universe?
This is exactly defined by the and then the impact theme. Each fund or product has, as I said earlier, has a theme, or it can have two themes, but there's a core theme. And these core themes define the universe of companies we are talking to. Because when I'm talking about energy efficiency, I have a different theme compared to sustainable food. And this is a different universe of companies. Now, what we do is we identify the theme. Then we have a certain range of companies in mind with certain criteria. And then we reach out into the markets. We look which companies are out there and which companies do fulfill our, if you want, so impact criteria. That's the very first question. And we look at these companies. And then once we have identified, we think, okay, this company could fit the equation. There comes, of course, the whole financial analysis, because they might fit, but they are not a good, financially good investment. So we have to look into this, of course, like any asset manager. And we run all of these investments also under what people would say, we do environmental, social, and governance check. So ESG checks. But this is for us, it's not, so it's just a necessary requirement. Every investment goes through an ESG check. It's nothing which we use as for positioning. So we do this all the time because we have to do this. But it's not enough for us, because for us, the companies have to fulfill also our impact criteria, which are not the ESG criteria. That's a different set of criteria, which the companies have to fulfill under the specific impact theme of a certain fund.
But your first cut at all this is more traditional finance.
Two things come at the same time. We look financially, and if the company is financially not sound, we can't do it. We cannot do it. I mean, it's just that there are limits. And the second thing is, at the same time, we look, but does the company have, in my terminology, a business model which is in line with our impact thinking? Because if the company doesn't have that business model, it also doesn't help us. So we need to bring these two things together. Yeah. And luckily, on these three themes, there are many companies out there who tick these boxes. Sometimes, and we have quite a bit of this, where we also approach account and the company might not be yet there. They have to learn the business model. Then we can use from time to time, we have also funding from government, which we call technical assistance, capacity building. So where we can, and we have a specialized team for this, where we can support a company in developing a business model. But that funding doesn't come out of the investor pocket. That funding comes out of other pockets, which are provided by governments typically, where they approach us and say, look, you have outreach to so many companies. So we are willing to finance and to support companies also on a different level.
And what are your typical ticket sizes?
Per year, we do between 1 and 1.5 billion. So it's basically an average 5 million average. We go down. We do also 2 million tickets. So we did in the past, even $100,000. We don't do that very frequently these days because that gets very, very problematic. No, too small. And it can go up. I mean, there can be tickets of 20, 30, 40 million. Yeah, that's also in the range. So it's not all centered around 5 million because it depends on the investee company. So when it's a larger company, which can absorb also larger amounts of capital, or for example, in the climate, it's kind of infrastructure light, ticket sizes can be bigger. So it can be a 20, 30, $40 million.
And is this ticket size more or less the same, both equity and debt side?
No, on the debt side, depending on the topic, we can do even smaller tickets. On the equity side, these days, on the equity side, tickets have a tendency to be a bit higher. Why is this so? Because the private equity process and the involvement with the company is very different from the private debt side. You know, on the private equity side, you are a shareholder. The fund is a shareholder and we represent the fund, and the involvement and the working together with that company is intense. When the ticket sizes are too small, it's very difficult to cover cost. And again, here comes the financial sustainability aspect. we also have to make sure that our own business has also to be cost covering. We cannot subsidize this. We have to say, okay, and therefore on the private equity side, ticket sizes have a tendency to be a bit larger than on the private debt side, but we are not talking, there are some investment topics on the private debt side where also tickets are larger. But for example, when I talk about sustainable food debt, then there are investee companies in Africa or in Latin America. So they are relatively small. So they might get a ticket of 1.5 million, let's say. And so therefore the tickets there are smaller than compared to other investments.
And your equity investments, do you have an exit strategy for these? Or do you have a holding period?
We do have holding period. Like, let's say we operate there, if you want, so like any other private equity, emerging markets. There are two things on private equity, which is very important because otherwise people will be confused. The private equity we do is there's no leverage. It's not like a classical US or European private equity fund would use quite a bit of leverage in it. We don't use. It's basically the money which we have in the fund does direct growth capital investments in this company. So it's very important to keep this in mind. The second thing is very often we are dealing with countries where the exit cannot come through the capital markets because there are no capital. In some of the countries, there are no capital markets. That means we have to do trade sales. So we look for strategic investors. And so, yes, we have to think about exits from the beginning when we do an investment, and we do. However, the reality is, and I'm happy to share this, of course, geopolitical situation can change, for example, and suddenly your exit strategy is very different from what you thought because it's just not the same environment. So that is something which, we have to be prepared for dealing with this, but we know exit, and it's not only with us, it's true for other managers who do private equity in these countries. Exit is a topic and it's a lot of work to make it happen.
And what are your target returns for these two asset classes?
On the private equity side, we are really competing also with private equity, growth private equity funds. It's just that our return doesn't come to, through the lever because we are not using leverage. Yeah. But we are really using commercial returns there, for because that's what we also see what can be achieved. When it comes on the private debt side, one has to differentiate which topic. And this is market condition. But I can give you the first, the very first fund, when you talk about the financial inclusion product, just, like 20-year track record. So typically you will see then that return in US dollar time over the years are around 4%, roughly. Now we have a phase with high interest rate that as we speak, returns are higher because interest rate levels are higher. So you have higher returns, you have returns above 6% or 7%, in that range. But of course, when you have an interest rate environment over 20 years, where the interest rate are much more lower, then also our returns are lower because that's the environment which determines this. But the range you have to imagine, it depends on many factors, but from highly diversified portfolios, which are in these ranges, then it goes more concentrated portfolios where you are more in the 7 to 10%. Then you are more in the mezzanine financing. You go into different or more equity-like, and then you are more between 10 and 15%. So it really depends on where you sit on the balance sheet and on the concentration in the portfolios.
I would like to now drill down on impact, and I feel that responsAbility has a unique approach. And if I've done my homework right, there's like 3 layers. The first is incorporating, as you've already referred to, an ESG assessment for risk mitigation. And secondly, there's an impact assessment that seems to assess impact capacity. And then lastly, there's an overlay of technical assistance and advisory to maximize results. I presume this is something that's proprietary that you've developed over the years. Is that true? And how was it developed?
It's not like there is not one unified approach for each investment. There are certain elements which apply to all investments. All others, you mentioned the technical assistance, is not applied in each investment. In some, but not in each. So the framework is this. First, do we have on each fund product a very clear, well-identified impact objective? Yes. This defines the universe of investable counterparties. When we do then go to the process and analyze, we see whether, and this is a long list of criteria, depending on the topic, does this counterparty fill that equation? Some do better or not so good, but is our minimum achieved? Yes or no? That has to be looked at. Then comes the traditional ESG assessment, environmental, social governance aspect, which we look into, where we also have to have a clear picture, where does the company stand on this? And then comes also parallel to this is what I call the financial. It's very important to mention the financial analysis is super important. Yeah. So for us, like as we are, you could say, Scott, your responsibility is a thematic investor. Yes, we do themes. So therefore, the understanding of what do we try to achieve with the fund is driven by a theme. And this makes it easier to apply a set of criteria, because when I talk, for example, about financial inclusion, I think we have such a broad, deep understanding of what we are looking for that we can be very precise on which practice in financial inclusion is for us, so to simply speak, a good one or not so good one. And to differentiate there, what do we want, where do we want to be, and where do we don't want to be. But that's something which you develop over time, over years. And so we have this and develop this, of course, for the 3 topics. And each new topic which comes up or might come up has to go through a process of developing these criteria, because the real critical things are in the nitty-gritty there, in the very specifics of a sector. And that can be very challenging and very demanding.
These authorized funds, or the criteria list, there's, I presume, established when you set up a fund.
Yes.
But this incorporates both the financial ESG assessment as well as the impact assessment, right? It's a combination. It's not iterative. It's not one or the other. So then in the impact assessment, you give each of your prospective investments an impact score based on something you call the 5 dimensions of impact principles. So
we can, when we have a system, where we score, there is more, but this is, if you want, so more fast for the internal processes, you see where the companies are. But the very relevant part is there are typically in the different themes, there can be situations where you find out something about the company where you say, no, this, even the other scores are good. The other parts are good. They are scoring high, but they are missing one element which might override the whole score and say, okay, no, this is not good because of this specific problem. And therefore, scoring, one has to be careful there. We do this, but it's not so simple that you say, just a score and it comes out, because specifically, when you get into a business model design and you get one element not right in it, that can be disastrous. And therefore we have to, be flexible in the interpretation of this. And that's the way we do this. Yeah. For example, when you pick financial sector, financial sector developments is sometimes criticized. Oh yeah, of course, it can lead to over-indebtedness. You provide financing to people. This can lead to over-indebtedness. That's a problem. And we are very aware. So therefore, it's super important for us to understand what is the analytics this bank applies to deal with and to avoid, to mitigate these problems. So we have to understand that part. It's a very important part. And so we design these type of, criteria because we need to know that when we invest at that point in time, we think they are doing the right thing. Things still can go wrong, of course, and we have seen it. The companies can fail for many reasons, but we want to see that, the approach is an approach where we say, look, it's for us, it's good enough to see that this company qualifies under our criteria.
If I understand you correctly, it's not really like you have these 5 dimensions and you come up with a weighted average score. It can be missing one thing that knocks the whole thing out,
Yes.
right?
Yes,
Right.
we can have these scores and averages, but I'm not a strong believer on the averages. Important thing is, are the key things fulfilled, yes or no? And there we dig deeper.
Once a company has passed this stage, then you move to the ESG assessment.
Yes, it always follows, and it basically the things happen in parallel. We look into this. And again, on ESG in emerging markets, you might find, I take, for example, governance. Let's take governance as the G. You might find a company where you say, whoa, there on a governance level, there are some question marks. They should improve. Now, the question is, do you exclude the company, or do you say, oh, the company probably wants to improve on governance, so can we use also our financing to push the company in the right direction? So you see, it would be too simple to say, oh, the company scores low on G, oh, we can't invest. So as we are in development investment, so we try to develop things, it's very important to understand that you cannot just say no to everybody, because we would find a lot of no's easily. We have to see, okay, but is this a partner? They understand where we come from. Why are we asking the question? They understand it, or they see, okay, here's something we want to improve. Can we include it into our collaboration? It can go even into a loan contract. And there are different ways of doing with this, because we want to basically, we are partners also in their development. That's a very important part. Yeah, it's not just simple saying, okay, we invest, we don't invest. It needs all of this.
A lot of these companies, in fact, all of them are privately owned companies. So this isn't in developing countries. So this isn't as simple as going to MSCI and getting ESG data. Do you have to collect your own data, or how does this work?
I very often say it's handmade. So what do I mean by handmade? It means, yes, there is somebody of our people reaching out to the company, collecting that reaching out means visiting, doing due diligence, or all these type of things. Of course, once we have established relationship, things can be also done over calls and sharing information. Yes, we have to collect the data. We have to do the assessment ourselves directly, because we cannot buy this data on the market.
So then you've got this impact assessment, ESG assessment. Then what happens at that point? Then it's time to decide.
Yes, then it goes always into different process. Let's say put it simple, investment committees, people look into this, and the decision is taken. Yeah, typically this process can be longer, depending. There might be some private debt deals where we already work with the company for 10 years. We have some clients for 10 years. Of course, the process is easier. You do the third transaction with the client. We know each other. It's different. Right? It's a new client, or you do an equity investment. Process goes much slower. It's much deeper analysis. It takes much more time. But that's what we do, and that's what our investors pay us for. To spend time with the companies, to put our know-how into this and say, look, we looked into this and we come to the conclusion this is a good investment under this topic. And here we go. And then we invest. And when we invest, of course, when it is a loan, there is always information flow over the term of the loan. When it is an equity investment, we are typically, of course, actively involved, because we are, for example, on the board of directors of that company, basically in most of the cases where we invest. That's a very different level of engagement. Yeah. Just to mention, and I didn't say this before, and I don't want to confuse people, but we do also, with one line of business, we do fund investment. So we do really, in your terminology, probably it's called indirect investment. So we invest into other funds. So like a fund of fund approach. There's very deep engagement with the fund managers, but it's again on a different level.
And you have advisory team that supports these companies once you make an investment.
Our people on certain topics now have also broad insights, and they can share a lot of best practice. And so, but there might be situations where basically we see the company has a need in a very specific topic. We cannot afford to have a huge advisory team because we cannot afford. But what we typically do there is, over the years now, of course, we have a broad network of consultants. And so you say, this company has a very specific need on a very specific topic. What we do is kind of look, hey guys, you can work with these type of consultants. And we bring in the consultants very often and say, look, these are the guys you can work with. And so this is actually an added value for the investee companies, which is highly appreciated. Because imagine we have the big luxury. We see in 70 countries, 300 companies, we see a lot across the country. And of course, when I sit in, let's say I sit in Indonesia, I know locally what's happening. I don't know what's happening in Peru because that's very far away and it's a different world. And so the access to information, how are people dealing with this problem in the other parts of the world? That know-how sharing is a key part of what we do also with our partner companies.
You've talked about these partner companies. We've just been through your whole investment process. Could you make it real for me with maybe an example from the private debt and private equity so that people listening could understand exactly what kind of company you're investing in or lending to and that they're on lending or on investing?
For example, if you take food, sustainable food, equity, you say, well, imagine there's a company in India who has built a network of thousands of smallholder farmers, collects basically their production and then processes and distributes the production of these smallholder farmers. So what's the topic there? There are two things. Smallholder farmers, including them into the formal economy. There are one, food production. And the other thing is this company, for example, I have a company in mind which I like very much because they provide training to the smallholder farmers on sustainable agriculture. So through that investment, we basically achieve that sustainable practice is applied on a much broader scale in this case, India and Africa, but they do it in both continents, India and Africa. And so that's what we like about the company. So it's a very concrete case. What do we do there? We do equity and we could also do debt and put that there. So both are, but that's a very concrete, another one, if I jump to make it concrete for people, imagine you are in Vietnam and you are working with a company who specializes in renewable energy projects. What they do, and we have quite a number of those, they work with local companies in Vietnam, in the region, who say, okay, I want to do a solar power installment on my roof or, what we call commercial and industrial renewable production. So C&I. So this company has specialized in identifying locally companies who want to invest into renewable energy. And this company needs financing because they buy material and then implement for these companies renewable installation, which contributes to have a better energy mix and to avoid CO2 emissions, because otherwise this renewable energy would not be available. So we then finance long-term this company, that this company can operate and do more renewable energy installations in the country, as an example.
Once you make these investments in companies like you've just given us examples, how do you track their impact post-investment? Do you have KPIs? I imagine they're different than the ones you maybe analyze them on. Maybe
it's not so different. The KPIs for a renewable energy production, installation company is different from a KPI from a smallholder farm. It's different KPIs. But we basically know what is key. And I'm a friend of simple approaches. This is already what we are doing is complicated very often. So it's very important to understand what are the key metrics which really matter for achieving an impact. For example, when you are in mitigation, you want to see that a certain amount of solar installation has been implemented, because this will contribute to renewable energy production. It's a chain which you can follow, and exactly when this is. The sun will be shining. Yes, you still have to make sure that are these installations in operation? Yes, no. I mean, you have to make some checks, but when this happened, and it is, you will get the impact which you are looking for. Climate is sometimes the easier one. When you work on inclusion or things can be more complicated, but what I only, and what, is, if you, to be very frank, in the whole industry, most of what is done when it comes to impact measurement is output measurement. And this it's very important to understand it. There's nothing wrong with this. That's okay. I'm offering insurance services, and okay, how many people do I reach? That's an output. That doesn't not anything say about impact. It's just, there is a new opportunity and people are using it. Very important, Scott, to understand. People buy the service. Now, when you buy an insurance, or you buy, if you want, so you take a loan, you pay for it, or you open a bank account, but you pay for it. Now, very important, poor people, if there would not be a benefit for them, they would not buy the product. You have to really, and therefore I'm so much insisting on, as we are not in philanthropy, as we are not in subsidy and donation, we are talking same level, we are talking partnership. And when people buy a service, that's in itself already a very strong signal that there is a benefit. There is a benefit coming out of this. Otherwise, they just would not do this. And of course, the analysis doesn't stop there. But what I think is very important to understand, it's a business relationship. People have new opportunities which come through these offerings. Now they demonstrate that they are using it like a mobile phone. I mean, who buys a mobile phone? You can then say, you are doing this because, yes, you want to use it for certain. And that's the same thing on these basic services, because people have to buy these in most of it. And there's no an insurance system available and you just go to the doctor. Typically, even when it comes to healthcare, people have to pay for this. Now, this signals the importance of it. And therefore, in the measurement, it's super important you identify these key points, which are important, which give you an indirect indication. Now, after the indirect indication, and nobody is capable of saying, okay, now we measure what did it do with the people? I mean, if you want the outcome, or even when you go one step further, the impact, it gets on the measurement part, it gets much more complicated. And yes, it's useful to do here, there to see whether the mechanic works in the right direction. But otherwise, it's very important to keep it also simple and to keep it efficient. Because don't forget, I typically ask investors, I say, yes, you want more impact measurement. We can do it. It costs you 15 bips extra. Guess what? The answer which I get very often from investors is, no. Then we keep it simple. You see what I'm kind of, the point is there is cost involved. And somebody has to pay for that cost. Therefore, we really emphasize a lot, it's very important to keep things manageable. Because if it's not so, yes, you might have a better feel or more complete picture, but the reality hasn't changed. It's just very costly exercise at the end. So we are very sensitive there.
What does sustainability mean to you personally? By this time in your life, you've made the decision. Obviously, you were voting with your feet, and you made the decision what you're committing your life energy to, right?
Sustainability, for me, is synonymous with resource efficiency. I don't mean to get too boring or technical, but actually, that really is the key. When I look back at everything I've done over the last 17 years, and I look at the way the world works, and the reason I wrote my book partly was to put all of those pieces on the table and see if it was still the same. The thing that's astonished me and motivates me more than anything is how much more efficient we can be with the use of our resources. Because going back to my childhood and my political convictions, the resources, meaning the stuff that we've always been mining, extracting, searching for, competing for politically, that stuff, and now that we're burning it, is creating climate change. That stuff are creating problems like conflict and climate change. But here's the exciting thing. We waste most of it. The reason I find that exciting is that that's a solvable problem. Like, if you were to wake up every morning and say, oh my God, what do we do? Like we've perfected the way that we operate, right? We're doing the best we possibly can, Scott. There's nothing more that we could possibly do. And yet, no good deed goes unpunished. Nothing more that we can do. And it's just getting worse. Okay, that would be a challenging thing. But when you wake up in the morning and say, we're wasting 3/4 of the world's energy, half of the world's food, and a third of the world's water, that's a deeply motivating set of facts. I think the other feature of it, though, is that it's motivating because you can design solutions to those problems. In fact, we took the I in SRI. Actually, that's what investment is all about. Investment is about trying to identify inefficiencies. Business is about trying to solve problems. So for me, sustainability or sustainable development for me is synonymous with resource efficiency, doing the same on what with less, just using less resources because we just use too much. We exceeded all of our planetary boundaries and the rest of it. But sustainable investment for me actually means solving those problems from a business perspective. And from an investment perspective, investing in inefficiency and solving those problems for me is the highest impact, most sustainable thing that we can do. You could argue there'll come a point in 25, 30 years when we would have arbitraged out from an investment perspective or perfected some of the inefficiencies. But we're so far from that, Scott. And solving that problem, how much of the stuff that we waste or squander today and the carbon and the cost of that, solving that problem for me is what the essence of sustainability is. More important than building new stuff is making sure that we're using the existing stuff more efficiently.
Is that true? 3/4 of the world's energy is wasted?
That question is the other reason I wrote my book. I'm a busy guy. I've got a business to run and the rest of it. And we've got $2.5 billion invested in 10 countries, 50,000 properties and so on. So, and I've got a family and they would probably have not lost me to, my computer screen for a year to do this. But it's actually to answer that question because it's so nuts, isn't it? It's extraordinary and it's unbelievable. And it sounds crazy. I'm very grateful to my publisher. It's a division of Hachette, Hodder and Stoughton, who published it, the second largest publisher on earth. But it's partly because I wanted to demonstrate this. But I'll break it down very quickly just to give you conceptualize it so it doesn't sound as nuts. In the energy sector, you have to get energy from somewhere. 80% of it's oil, gas and coal. So generally speaking, you lose, first of all, about 10% of the primary energy just in extraction and conversion into the system somewhere, to pipes, into making it into a grade that it can get used in the energy system, say in power plants or in the transport sector. So it's about a 10% loss, 9%, 13%. That's a small part. The biggest part of the world's energy gets lost as heat. It's about half of it. In fact, that's being charitable. About half of the world's energy gets lost as heat. For example, everybody thinks of electricity, so I'm just going to go along with that for a second. But if you think about a power plant, like a gas-fired power plant, which is the largest fuel source for power in any major economy at the moment, if you put a molecule in a power plant, half of it turns into electricity, the other half turns into heat. By the way, which is fine if you use it, but if you've got a centralized power plant, which is how we've built the energy system in America and in Europe, centralized power plant, the electricity goes into the grid, but the heat goes up and there's nobody close to use the heat. So they just dump it, it wastes. It goes, in fact, it doesn't disappear. It just goes up into space where it's not really needed. But think about this. By the time the power has come out of the power plant, 60% of the primary energy, the original fuel, has been lost. 60%. Now, then it goes on to the transmission and distribution wires. So by the time it's in your building in Mexico or mine in London, another 10%, so 60% plus 10% has been lost on average. So in the United States, since the 1970s, the Lawrence Livermore National Laboratory has been calculating what they call useful energy. That is the amount of energy that gets from the primary energy source to the end user. And then what they call rejected energy. In other words, the amount of energy that gets lost in the system. And very broadly, it's been between 67 and 70% since the 70s. There's lots of things that haven't changed since the 70s. We're still almost entirely fossil fuel based as we used to be. And we still waste most of our energy, even before it gets to the point of use.
That's extraordinary. I'd love to drill down more on that, but we got to get to SDCL. Maybe you could start with a high-level overview of SDCL, and maybe start at the beginning with its mission and just describe at a high level for a moment its activity, investing focus, and you could walk us through the timeline of SDCL to becoming what it is today, because you started out as advisory and now you're investing.
That problem that I just described, the fact that we waste most of the energy, is actually the mission. It's the mission of SDCL is to solve that problem. And tying a little bit back to kind of the prehistory, the first 5 years I described to you earlier as doing a lot of work for financial institutions, but there was another side to our business in parallel, which illustrated to me the opportunity of solving the problem. It wasn't just financial institutions that hired us as an advisor, it was companies. And it's companies to solve the physical problem, because the companies recognized, as it stands today, that 90% of their carbon footprint was in their supply chain. And in the late noughties, big companies, I won't name them for today, but very big famous brands wanted to do something about this. And they hired companies like ours, actually, to go out and find solutions to these problems in their supply chain. And we found solutions in energy efficiency, making factories more efficient, reducing the amount of energy that was wasted at the point of the manufacturing process, which reduced the carbon and so on. So by the time we started investing in projects in 2012, with the mission to cut energy waste, to invest in solutions to this big problem, we knew a lot about the subject. We knew that there was a funding gap because of our experience in the financial markets, but we knew literally from the coalface, from working on the ground and factory floors in China for big international brands, working in hotels and data centers and hospitals, we knew that there were problems on energy, that there wasn't enough, let alone low carbon. There was availability problems with energy, there was high cost problems with energy, but it was also just huge wastage in getting it to the point of use. And also when it was there, the buildings that were using it, buildings, industry, transport, 70% of energy demand, were using it inefficiently. So by the time we started investing, we knew what these problems were, but we had also started to design solutions to these problems. What does that look like? So if you want to solve the problem that the grid's incredibly inefficient and wastes 75% of the energy before it gets to the point of use, you can generate energy on site, and that cuts out generation, transmission, distribution losses. As our mission as a financial investment firm, we started to develop physically and then financially invest in projects that solve these problems. So we decarbonized hospitals and data centers and hotels using the equipment that we had learned about as an advisor, but then deploying capital to turn the projects into a service for customers. Customers didn't have to spend money to implement the project. They didn't have to know how to implement the project. We would design the project. We would explain how. We would provide the capital. And then clients would pay for the energy service that we delivered for them that was lower carbon, lower cost, and more reliable. Very often, most often out of the savings generated, because we were able to make the whole system so much more efficient. That's how we started our journey as an investor, but that's exactly where we are today. It's actually the same fundamental idea we had as we started investing in 2012 in solutions to these problems in buildings, industry, transport. All we've done for the last, I'd say, 14 years is more of the same. And we've now built projects in our portfolios that connect to over 50,000 properties in 10 countries. We've solved these problems for steel mills, chemical plants, very excitingly, the data center market, for hospitals, for government buildings, for logistics parks and facilities, even for residential communities. So this is what's exciting. This basic problem that we identified years ago, there are solutions to the problem. And we've built a portfolio now of over $2 billion of projects which solve these problems. So if somebody asked me today, can it be done? We have quite a big set of proof points.
I want to drill down on that more, but let's first start out with an overview. You've got a couple funds that you're doing. I think your largest one in 2018 you launched is SEEIT, which was the first UK listed investment trust focusing exclusively on energy efficient projects. So first of all, how did the name come about?
Nobody's ever got the joke. It's what my kids would groan and say as a dad joke. It's just see it. Can you see it? But it's the SDCL Energy Efficiency Income Trust. That's what the acronym stands for.
What is the ticker?
The ticker is SEIT.
Okay.
And it's traded on the main market of the London Stock Exchange. And look, the investment thesis was to invest in, I should say, and then improve projects that deliver energy to customers that's lower cost, lower carbon, and more reliable. But through the same techniques I was just illustrating, that is on-site energy generation that avoids the losses associated with the grid, and also projects that reduce the amount of energy that buildings use. So, for example, more efficient lights or heating, ventilation, air conditioning systems. For me, those are the two most impactful, profitable solutions to the energy problem. In fact, it's actually what the acronym of my book means: efficient and decentralized generation of energy. Efficient meaning, can we change our infrastructure inside of buildings, industry, and transport to do the same job or more, just using less energy? And the answer is yes. The Department of Energy in the US says that about 30% of the energy inside buildings is just wasted because it's got the wrong lighting, heating, ventilation, air conditioning system. I agree with that because that's my day-to-day experience. So we invest in solutions to that problem. And then the decentralized generation is things like it's got solar and storage. You just put energy exactly where it's needed and deliver it directly to the end customer. Cogeneration, recycling waste gases or waste heat and using it to create power and steam in the industrial context. So that's what our portfolios do. And that's what See It does. It buys mostly operational projects and then expands them and improves them and scales them up.
Why did you decide to launch as a PLC rather than a PE fund?
It was a PE fund in a sense. We launched a fund backed by the British government in 2014, and it was called the UK Energy Efficiency Investments Fund. It was actually cornerstoned by the British government's Green Investment Bank. So it was a first of a kind fund. It was the first institutional fund in the UK to invest in energy efficiency projects. And the mission of the fund was it's about £100 million fund. The mission of the fund was to design, build, finance, and then operate and maintain a series of these projects, on-site generation and efficiency projects. And the fund had done, I think, a great job because it closed in 2014. And by 2018, it had basically committed its £100 million and it had got its portfolio operational. So what happens is, Scott, in private equity or infrastructure funds, there comes a point at which your investors expect you to exit or recycle their capital. And that would happen relatively quickly, about 4.5 years after we launched it. We looked for opportunities what the best opportunity was for investors at the time. And candidly, I recycled the same idea that we spoke about earlier that I had when I was at HSBC, and we had the same problem in 2006, and said, okay, one of the best ways I've ever seen to exit an infrastructure portfolio that's working great and then to scale up the strategy is to list it on the stock exchange. I did that the first time in 2006. Why don't we do it again with the UK Energy Efficiency Investments Fund? That's exactly what we did. And in December 2018, we took it public, and that was the beginning of See It.
And what's the total assets under management?
So the enterprise value of the portfolio is about £1.5 billion, and that's comprised about £500 million worth of debt financing of projects and about £1 billion of equity.
Who are the investors primarily?
It's a blue chip shareholder register. Thrilled. A lot of it's in the public domain, but the typical characteristic would be insurance companies, pension funds, institutional asset managers, private client stockbrokers, some very large, institutional funds. More and more these days look at See It as a proxy for an operating company, that owns energy assets all over the world.
Is most of the capital in there already deployed?
All of the capital is deployed, and it generates cash flows. Those cash flows then allow us to service a dividend. So it pays dividends quarterly.
And targeted returns, what do you shoot for?
The latest valuation that we conducted, and we printed our annual report and accounts in June related to the end of March, the discount rate or the rate of return that applies to our portfolio at its NAV is about 9.5%, or about 11 levered. So that gives kind of a sense of what the total return might be expected to be from our net asset value. I think good news for new investors, not so good news for existing investors, is that the shares trade below net asset value. So some might say it's a remarkable investment opportunity for investors who can buy shares in a company below its net asset value.
What are you benchmarking against? Utilities or what? I guess you're not generating energy, but
in any investment thesis, in an investment case, it's a layer cake is probably the best way of describing it. The base of your layer cake has to be risk-free rates. And then, there are risk premia that attach to the specific, the sectoral, but also the specific risks that you're investing in. So when we look at our portfolio, we'll look at the risk-free rate in the relevant country. We'll look at the risk premium associated with corporate credit. We'll look at the risk premium associated with the liquidity or illiquidity of whatever we're holding. We'll look at whether or not there are construction risks, Scott. So if we're building new projects that put solar on people's rooftops and commercial industrial context, we'll take that into account. We'll take the operation and maintenance risks into account. So it's a stack of risks which have a commensurate return. And that's broadly how we calculate the discount rate or the rate of return that we require on any new investment.
I want to cover the other things you're doing. In 2023, you launched the Green Energy Solutions Fund. This is private equity?
Green Energy Solutions Fund is exactly as you asked me. Why didn't you do a regular private fund? The Green Energy Solutions is a regular private fund, but as opposed to the public company, which invests mostly in operating assets, the regular private fund invests much earlier in the development and construction phase of projects. A typical client of that fund, it's a 650 million euro fund. And by the way, we have 100 million. Within that context, we have a £100 million partnership with the Mayor of London, specifically to do this in London. But what we're doing in that fund is investing in the development and construction of new projects that can decarbonize buildings, industry, and transport. So a typical client would be, I'll give you some examples. You could be a data center operator, right? And you could decide that you need to service your new data center, you need low carbon power 24/7 at a reasonable cost. So our fund will come in and do the work to develop and then invest in the construction and then provide us the energy service to the customer. That's a typical customer. Another type of customer for us would be an industrial customer that wants heating, cooling, and power 24/7 for their manufacturing facilities. It could be a hospital. It could be any other form of large corporate and industrial logistics client. But what the fund will do is invest the capital to develop and construct the project and then earn a return by providing an energy service that's lower carbon, lower cost, and more reliable than the grid.
This is for qualified investors, probably.
That's an institutional fund. The minimum tickets are much, much larger. It's actually closed. We finished the fundraising just above our target size in October last year. And it's characterized by very large financial institutions, again, insurance companies, pension funds, one or two sovereign. And
does this get what one would call private equity returns, or is it a similar profile to the listed to see it?
It gets private equity infrastructure returns. So it gets similar returns to the public company, I would say, because it's investing at a slightly earlier stage at development and construction. It gets a premium return associated with the additional time, cost, and risk associated with that.
You consider all this real asset investing? Yeah. Okay.
Yeah,
this is clearly in real assets. Yeah.
All of our infrastructure equity portfolios are clearly in real assets. They're all backed by contracts. We own equipment and we're delivering energy services to customers. We do have, and that is the supermajority of our investment portfolios, we do have a private equity capability. So we do like to use our knowledge of how the energy system works, particularly what buildings, industry, and transport need. And we like to use that knowledge to identify companies selling products and services into the supply chain that can help buildings, industry, and transport decarbonize, because that's our core business. So we love investing in infrastructure projects, but we also love to try and find companies that are doing a great job providing products and services in infrastructure projects and services into those markets. So we have a private equity business too, and that's something that we're definitely excited about scaling up over there.
And that's something that you just went into last year with an acquisition of Volaris, so right?
Correct. Yeah. So we have had a very small portfolio of private company investments inside of SEIT. Actually, about 3% of SEIT's portfolio can invest in companies, and we've had some great success in doing that. But to scale that capability up and to make investments in slightly later stage growth capital opportunities. We acquired a very good group in Greenwich, Connecticut called Valerie Capital back end of last year. They've been long-standing partners of the firm, a team that we knew extremely well. So we're delighted that they joined and merged their firm into us in back end of last year. And that's a business that we really want to scale up because we can help a lot with these companies.
Outside of these investment strategies, you do project management and advisory services as well. Is that correct?
Our funds are not just investment funds. We have active asset management teams at SDCL. I guess if I were to characterize the two types of people in the organization, typecast them, it's physical and financial. So we've got the physical capability of designing and then project managing the construction and overseeing the operations of projects on the one hand. And then we've got the financial capability to evaluate and invest and buy and sell investments. That really characterizes what we do as a firm.
Just to draw a line under your business model, what is a split of operations in your business? How much of your revenue or your operations are derived from actual investing versus advisory versus project management?
It's almost all investment. Our business model is that we run funds and we run those funds on behalf of institutional investors that bless us with their trust to invest their capital in projects that are sustainable, not just for the environment and society, but commercially sustainable. Indeed, if it's not commercial, it's not sustainable. That's our regulatory and business objective, and client outcome. What sits on the other side of that, though, is that we're investing in projects that are delivering critical energy services to customers. That's how our funds are deriving revenues under contract. They're getting their revenues from providing energy services through these projects. So we're paid by our investors, but at the end of the day, their returns come not from us, but from the underlying projects that we manage on their behalf. So it's about spiritually and physically, it's about half and half. Half of our time, more or less, is spent making sure that our physical operations are performing at their peak and the best they possibly can. And we do everything we can to improve those assets, manage the risks, deal with the uncertainties that life offers sometimes. And then the other half of our life is making sure that the investment decisions we're making, the risks, the financial, the administration that goes along with running billions of dollars of institutional capital, that's being done properly.
I know you're operating internationally. So what regions are you active in? What countries do you have actual employees on the ground?
As an investment firm, we have about 55 people here at SDCL that work directly for the firm. But we have somewhere between 350 and 400 people under full-time employment through our portfolio companies and projects. Those portfolio companies for our projects, about 70% of the value is in the United States of America. I think this is right, although we may have done a project but I think right now we've invested in every state in the United States other than Hawaii, which is nothing wrong with Hawaii. We just haven't managed to get something done there yet. That's about 70% of our capital. We've got a very large footprint and growing footprint, rapidly growing footprint, I should say, in Europe. The Republic of Ireland is a really big market for us. That's obviously a hotbed of the data center market, which is a very large focus for us as an industrial vertical. UK is our home country, but has a relatively small proportion of our capital invested here, looking to do more, hence our partnership with the Mayor of London to launch a fund specifically for the London market. Spain, Portugal, so the Iberian Peninsula, we've got circular economy projects, cogeneration projects. Sweden, we've got a fantastic network in Stockholm. So we are actually Stockholm's gas grid, but don't worry, it's a green gas network. It's taking mostly the waste gases from wastewater treatment plant that would otherwise be polluting, and we use those as the gas network for Stockholm. And then we've got a small footprint in Asia, actually. Going back to my HSBC heritage, we've had an office in Hong Kong, we've got an office in Singapore, and we invest in projects in Singapore, Vietnam, and we're moving into Malaysia.
I think you've hit all around this, but I'd like you to succinctly tell me what's SDCL's theory of change and the problem or the problems that you're trying to solve specifically.
Our theory of change is that we think that the intersection of the energy with the economy and the environment, the interface of those three elements is the most fundamental issue that we need to look at for the next generation, primarily because of climate change, but also because of other socioeconomic factors that emerge and even geopolitical factors that emerge. So our theory of change is that something has to change and that nothing much has for the last 20 years. And I don't mean that in the sense that we haven't been well-meaning. And I'm not saying that we've had bad policy design, but I'm being realistic. So come back, I'll give you a theory of change in a second, but what's the theory of non-change? The theory of non-change is that how can we say that there's been change when over the last 20 years, after $9 trillion of investment in clean energy and in the grid, with everything that we've said and done, with the UNFCCC, with Nobel Prizes, with movements, how can we say there's been change when particulate emissions have been going up about the same every year over the last 20 years with barely any detectable difference? How can we say that we've made a change when the proportion of fossil fuels in the global energy system is about the same as it was? We've added, there's more of everything. We can say that the energy system of a century or 2 centuries ago was bioenergy and now it's dominated by different forms. Well, we just use more bioenergy than they did 100, 200 years ago. It's just more of everything, right? So that's the theory of non-change. The theory of change is this. What if we needed and wanted to do something about this? What if we needed to cut carbon? What if we needed to improve resource efficiency because we just are using much more than the planet can produce sustainably? Our planetary boundaries have been blown over the 9. We're just using too much. We're probably using 1.75 planets of resources a year. So what exactly can we do about this? So my theory of change is as follows. The largest, fastest, cheapest, and cleanest source of greenhouse gas emission reductions and reduction in extraction and social destruction associated with extraction of minerals and metals. The largest, fastest, cheapest, and cleanest solution to that is being more efficient, doing the same or more with less. So just at the same time, it's not to denigrate it, just at the same time as we spend the next decades innovating and building the best, cleanest infrastructure we possibly can, renewable power and the rest of it, the theory of change is we have to be more efficient. We have to cut out as much as we can of the 75% of the energy, half of the food and a third of the water that the world's wasting. And by the way, Scott, if we don't, we're not going to get anywhere. Not with net zero. We're not going to have a sustainable economic environment, and we're going to keep having wars over the stuff that we're fighting over.
I guess you've identified energy efficiency as the low-hanging fruit of this problem out there. What does it mean in practical terms, and what does it mean practically? Because I'm sure there's a lot of people listening who haven't thought much about this as an investment concept. I'm sure a lot of people have heard it referred to because it's not an uncommon term in the business. It's thrown around a lot. But I want to make sure we're all on the same page today, what it means to you and SDCL, because I want to get down into how this generates a return.
I'll start with like a very, very pure version of efficiency. So let's say that you own a portfolio of 800 buildings around the country, and let's say that you're a bank. Santander Bank is a great example of this in 2015. At the time, certain clients still suffer from this, like the NHS today. But at the time, Santander recognized that almost all of its lights were inefficient. Like, for example, they had sort of regular light bulbs. By changing those light bulbs to LED light bulbs, they identified with a technical partner of ours at the time, GE Lighting, that they could dramatically reduce the amount of energy they were using. Now, they didn't need to turn the lights off. Like, they could have the same lighting product, even better actually, because it would require less maintenance. It's just that it would use much less energy. So you could take out of a ceiling a 60-watt lamp and replace it with a 6-watt lamp, and it would make the same amount of light. But de facto, it would reduce the amount of energy like for like by 90%, right? So this was kind of the opportunity, or what you would refer to as low-hanging fruit in 2015. What we did is we worked with GE Lighting to design a system where we didn't just replace one of those light bulbs, we replaced 90,000 of them in 800 buildings all in one go in a 9-month program. Okay, here's the other problem. This is the financial problem. If you're you might think Santander has all the money in the world, but it's still a company with an operating budget. So the cost of doing that was about $20 million. Now, that $20 million was not a normal operating budget for their facilities management business. Second of all, it required an extraordinary level of project management and coordination. So it wasn't just capital, but it was help. Somebody had to take responsibility for changing 90,000 lights, right? So that's where we stepped in, and we wrapped the project up to make sure that it had the right delivery capability to design, install, and operate and maintain. And instead of Santander having to pay $20 million to implement the project, we paid the $20 million, and we charged Santander a fee to provide light as a service to them for 10 years. So that's how we turned it from a problem into an investment. We made our investment, which was the capital expenditure to install the project, and our return was the cash flows associated with the service charge that we charged Santander. Now, for Santander, it was a great deal because the payment that they made to us under our service charge, which was our income, our return on investment, was less than the payment that they would have made had they not changed their light bulbs. So actually, they just paid us out of the savings.
When you say less than the payment they would have made, is this for their power payment?
The payment that they would have made was two things. Previously, they were going back to my example of a 60-watt lamp for a 6-watt lamp. For every single one of those lamps, they were paying the money involved with running a 60-watt lamp rather than a 6-watt lamp. So it was much more expensive. After we installed the lamps, then, of course, the price went down very dramatically. So it involved a very substantial financial saving for Santander. But in addition to the financial saving, if you think about a lamp burning 60 watts compared to a lamp using 6 watts, the carbon efficiency was so much better afterwards than before. So Santander were getting two benefits out of this. It was a significant cost reduction, but also a significant carbon reduction. And then there was a third benefit, which was the quality of the infrastructure. So once we'd made the investment, they used to have people running around the country in white vans doing emergency repairs for light bulbs that kept going out. But as we all know, LEDs come with warranties, 5-10-year warranties, which means that you don't have to replace them. Or if they did, they'd have a phone number they could call and somebody would come out and replace it for them. So we delivered the project as a service for Santander. There was no upfront capital cost. They paid us a return on our investment, our $20 million, over time as a service. They paid for a light as a service over 10 years. We earned a return on our investment that was acceptable to us. Santander paid us for that service, but it was less than they would have paid for those very expensive 60-watt lamps.
And is this service something that is effectively calculated and negotiated when you go in with the project, or are you paying the power bill and charging them what they were paying before? How does it work?
They carry on paying their energy bills. They're just paying less because they're not using as much energy. They pay us for the lighting as a service, but they don't pay us, Scott, if the light isn't available for use. So they pay us so long as the lights are available, so long as they don't degrade below a certain level, so long as the color temperature was what they wanted, and so on. So there are key performance indicators. So that's a very clear. We've done many of these projects in the UK, in the US, and around the world. But using finance can spread the capital cost of an asset over its useful life, right? And also in infrastructure investors like ourselves can take risk. We can take the risk on the design, the implementation, and the operation of projects. So that's what this does for clients. You know, we design, install, operate, and maintain projects with our industrial partners, and then clients can pay for the service. They only pay to the extent the service is made available to them. So in, for example, lighting, or you could do this with cooling or heating. But in each case, the client has the benefit of paying for the project as a service, but the payments they make, including our service costs and all the electricity costs that they're paying to run their system, are less than they would have been had we not done the project for them. So that's on the kind of the savings side. Something that we learned over the years, and I referred to it at the beginning, is that, and here's a bit of a tragedy, you can make your building. This was a heartbreaking moment for me because I'd done all these projects for Santander and all sorts of other customers, and we tried to make these buildings as efficient as possible. And then the realization was, oh my God, like actually most of the energy's been wasted even before it's got to the building. Here we are. This is what we were saying to the Mayor of London. Well, we've just launched a new fund with them. Here we are in London. We could make all of London's buildings more efficient, but 2/3 of the energy has been lost before it gets into town. Going to the point that I made before through the extraction, generation, transmission, and distribution process. So what can we do to solve that problem? So that's the other side of the coin, on the other side of our investments. And to solve that problem, you asked about practical examples. We will build the energies, that is the power or the heating or the cooling service, at the point of use. So rather than if you've got a data center, Scott, in the middle of town, rather than you having to rely on the grid, where by the time the energy's got to the data center, 2/3 of the energy's been lost on the way, instead we'll build the energy system right there at the point of use. And we'll produce as low carbon as possible, 24/7 power, cooling for a data center. If you're a hospital, we'll provide power, heating, hot water, cooling. If you're a logistics facility, we'll put solar panels on your roof. And instead of you losing the energy through the transmission and distribution system and paying your utility bill, half of which has got nothing to do with wholesale energy prices, it's got to do with the cost you have to bear for the network. Instead of doing that, we'll produce the power cheaper, cleaner, and more reliable for you on site. The UK's, we were joking about it before we got started, but the UK is not famous for being a very sunny location. But from 2019, it's been cheaper to buy solar power that you produce on your own site in an industrial context.
I'd like to drill a little more into your See It investment vehicle and strategy. Who are typically the end users in these projects?
Big market for us is actually steel. Not tremendously fashionable. Doesn't sound particularly green, does it? Steel is a big deal. I mean, everything relies on it. Really, you can't build wind turbines without it, Scott. So, you have to accept that it's got a role to play. A lot of the steel industry, although it's moving to electric arc furnaces to be more environmentally friendly, amongst other things, it still relies on blast furnaces. So, for example, we have a major project in See It's portfolio that I think is absolutely fantastic. When you've got a blast furnace, typically they can reject gas, hot gases, and they literally boil the atmosphere. The project that we've invested in See It's portfolio serves Cleveland Cliffs, the old ArcelorMittal USA steel mills, and US Steel, famously, going through a merger at the moment. And it serves those steel mills by capturing waste gases, waste heat, effectively, coming out of the blast furnaces. What would otherwise be pollution boiling the atmosphere is captured, Scott, and it's piped back into turbines. And the turbines then produce steam, which is needed by the steel mills, and power, which is needed by the steel mills. So what it's doing is it's recycling energy. What would otherwise be waste, part of that 50% of the world's energy that goes up in smoke into space, what it's doing is it's capturing it, recycling it, and putting power and steam back into the industrial process. And it's doing it at big scale. We've got about 298 megawatts of on-site generation, most of which is recycled energy. It's so impactful that it gets about 1.5 clean energy or renewable energy certificates for every one equivalent megawatt in the solar market, for example. So that's how beneficial it is from a pollution prevention and energy recycling perspective. That's what I would call, people call that hard to abate in the steel industry. Steel, cement, chemicals, and plastics is about 40% of the world's greenhouse gas footprint. So, that's a big one as an example. We've got a project in the northern side of New York State, and that runs 16 utility services on site for about 116 customers, big logistics and fulfillment customers through to the food and beverage industry. So that's a very interesting network. We have one of the largest solar and storage platforms in America in See It's portfolio, a company called Onyx Renewables, which does solar and storage across schools, hospitals, government buildings, commercial and industrial facilities nationwide. We've got lighting as a service, going back to my Santander example, across the country through one of our portfolio companies. So that's what's in See It in the US. In Europe, I mentioned Stockholm's gas grid, which is fueled mostly using the gas that would otherwise be spewed out of the back of wastewater treatment facilities, but instead is captured by us and used as the gas network for Stockholm. We've got projects that serve the olive industry in Spain, the paper industry in Portugal. And then you asked me to be insinuated that steel mills in the United States weren't sexy. So let's try this one. Hyperscale data centers in here in Europe is a market that we've been very focused on for years, because SEAT, for example, got started. One of its earliest investments was owning on-site energy generation systems for companies like Citigroup, where we own and operate their critical energy service. Energy center for their data center here in central London. So that gives you a sort of flavor for the portfolio. It's high quality projects. It's contracted with end customers. The contracts deliver customers energy at an affordable price, which is typically lower, substantially lower than the grid. Energy that's designed to be lower carbon than the energy system of the countries in which it operates, and energy which is designed to be, and this is really critical for sustainability, reliable. Because, we have to wake up, I have to wake up every morning with my 50,000 customers. So, it's got to be available. It's got to be reliable. It's got to be secure. And if you're a data center, a hospital, a steel mill, a manufacturer, you're going to rely on these projects to deliver the energy services that you need when you need them. That is the characteristics to its portfolio: cheaper, cleaner, more reliable.
How do you define your investment universe? What are the key screens or hurdles that have to be passed for you to move forward on something?
The primary philosophy behind our projects is going back to the problem we're trying to solve. It's not how do we sell more solar panels or batteries or hydrogen fuel cells. It's how do we get the lowest cost, lowest carbon, most secure solution for our customers. So the first question is, who are the customers? The customers are buildings, industry, and transport. That's where 70% of the world's energy is used. That's where the battle's going to be won or lost around carbon, around the economy, and around the environment and society. It's the actual end user. Most people think about the grid, Scott. There's nothing wrong with the grid. It doesn't have any feelings, so it's convenient. But the buildings, industry, and transport, that's where the action is. So that's our customer. So that's how we define our universe. Then what's their problem? Where are they? What do they need? It's typically one of those three things, or all of them together. And then we'll design solutions to those problems, or we'll invest in solutions to those problems. And the solutions take many, many manifestations. But it's either on-site generation, or it's projects that reduce energy consumption, lots of different technologies, but you're solving the same fundamental problem every time. How do I produce a solution for this customer that involves wasting less energy than the grid?
So one of the key differentiators of your investment strategy, if I've understood this right, is there's no upfront capital required for the end user by the target company that is deploying the energy efficiency project. In the example you gave me of Santander, where you're providing light bulb service or lighting service, I don't know how you described it, does that have a term that expires? Because that's really kind of a service that's got calculated savings, as opposed to when you're constructing decentralized energy generation. There you've got a real PP&E, and I imagine that's a standalone asset that you eventually maybe spin off.
You're entering into a contract, let's call it 10 years, to provide light. You could also be providing another service, another energy service like power or heating or cooling. So our projects will own the equipment that deliver those services, lighting, heating, power, or some derivative thereof. It's typically under a contract with a limited life. You're right, about 10 years, 15 years. Some of our contracts go 20, 30 years, but the typical average life in our contract is actually about 15 years. So throughout that period of time, we will provide the energy service to the standard documented under the contract. Scott, if you're a data center and you need energy made available to you when you need it, you pay us our service charge. It could be a 10, 15-year contract, and we will deliver you the energy service. And to the extent that we don't, you don't pay. And all of our contracts fundamentally work in a similar format.
Let me move on to drilling down on impact. How do you measure impact and monitor impact? Are there KPIs that are super important to you, or how do you do this?
We think about this very, very deeply. We actually won the ESG Communications of the Year award for our public company for SEAT last year, and our Business Green Award this year. I think it's working, but the thought process is, how are we saving energy? And therefore, can we count that in carbon emission reductions? It's a monitoring, measurement, verification exercise. We then translate that into carbon emission reductions. We also look at other environmental and social metrics that we publish in our ESG report. The calculations and quantification of that is then made available in the public domain through our annual report and accounts for the public company and to all of our institutional investors through the private funds. So what success looks like to us certainly is health and safety first, is in providing around-the-clock energy services where we need. But from an environmental reporting perspective, it's carbon emission reductions, and it's also to the extent that we can quantify them and articulate them, the other environmental and social benefits associated with what we're doing. I firmly believe that we've got a big problem to solve in this world, not just to create more clean energy infrastructure, but to stop wasting this ridiculous scale of waste in the system. So, we calculate the impact that we're having on that because we think it's the largest, and sort of fastest way of cutting carbon. Last thing I'd say on that side is a bit higher level than your question, but I've just got to say it out loud. I've been doing this for 17 years, and I'm sure there's lots of people listening today that might have seen something that I haven't, but I've never seen any evidence of anything that can generate energy with no carbon. There's embedded carbon in any form of energy generation. However, I think it's perfectly possible to create a negative carbon energy project by reducing the amount of energy that's needed to do the same job. That is, reducing energy demand in the economy. And that takes carbon out of the economy. So if we can come up with better solutions around the E and edge, efficient solutions that just involve using less carbon and less energy to do the same or more work, and we can do decentralized generation so that we can cut out waste in the extraction, conversion, generation, transmission and distribution process, that's negative carbon. That's carbon out of the economy. So while it's incredibly challenging to generate zero carbon energy on the supply side, it's extremely exciting to think that you can measure, quantify, and deliver carbon savings on the demand side.
Based on what you just said, you feel like there's huge opportunity scope that remains to generate additional impact, that we're at the front end of the runway for your strategy.
I think we're just getting started. I mean, I'm delighted to have been at the helm of SDCL for 17 years. I fully hope and expect to be here for the next 17 years. I've created the firm that I want to work in, and I'm doing what I think is the highest impact job I can. I also feel like we're just getting started. As going back to it, over the last 20 years, if you measure the incredible success, I'm so happy walking around COPs these days with this level of interest and finance and media attention. But it's just fantastic to see the level of interest and experience that we now have as a society in building renewable power. But nothing like that $9 trillion has been invested in solving the problem that we've been discussing today. The return on investment for that, I think is absolutely extraordinary. To give you one little example, nugget, which I always like to give. Obviously, we're on the brink of an election in the United States, and we just had one in the UK. So I'm going to say this just as a little example of something the government in the UK might like to think about. But the biggest energy user in the UK is the National Health Service. It uses about 5% of all the energy in the UK. Going back to my lighting examples earlier, less than half of the NHS's light bulbs have been changed to efficient lights or LED. Just doing that would save the NHS £1 billion by the end of the decade, let alone being the fastest source of greenhouse gas emission reductions and creating a better lighting estate for patients here in the UK. Just gives you a sense. Yes, we're at the foothills. The way I like to think about it is I spent 17 years getting to the equivalent of the base camp of Everest. I'm very, very pleased and proud to be at the base camp of Everest. We're backed by some of the world's biggest financial institutions who've been.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.